Explain.
Yeah, so I think the main thing that's been challenging to the oil market right now is we've seen distinct weakness in the very light end of the barrel, the liquefied petroleum gases, ethane, propane, butane, even naphtha, which are heavily dependent on the manufacturing petrochemical cycle. In contrast to that, we've seen the reopening of the Asian markets, China in particular, which is leading to service-related demand growth in jet fuel, diesel, and gasoline. And we've had a pretty big bifurcation. The light end weight, though, is really showing up in pressure on the very light end crude oils, which has actually been the crude oil that we've been able to grow globally, in part because of the growth in the U.S. production. In contrast, much like in the bifurcation of refined products, we've seen a reduction in the medium and sour crude oils that key OPEC producers export. So we've seen this growing detachment between different parts of the barrel that I think has been sending conflicting signals to the oil market. In my view, if we see Sorry.
Yeah, I'm sorry to interrupt, but I'm curious if you just could kind of explain, though. So, I mean, what kind of drove that bifurcation, though? I mean, I know some of it probably had to do with the war in Ukraine and the sanctions on Russia, but were there other factors as well?
Well, there's been a real turn down in the energy-intensive industries in Europe in particular, where we have seen, if you look at the IP indices, the new order indices, you actually back out industrial demand from looking at daily pipeline consumption statistics. We have not seen any rebound in European energy-intensive demand. That has led to a depressant force on petrochemicals, and petrochemicals really is the linchpin for a lot of these lighter molecules and drive a lot of the demand for them. So if you have a weak manufacturing and durable goods cycle, that's where the weight is most pronounced. And I think that's the primary driver of that challenge in that end of the market.
So for those of us, Greg, who don't know this industry as well as you do, we look, of course, a lot of times to crude products, to energy products overall, as kind of a barometer for economic conditions. As a barometer, what is it actually telling us about economic conditions?
Well, it says the service sector is doing quite well. If you look at the strength in the diesel markets, you look at strength in gasoline markets, you look at jet, we've seen a real turn up in demand. You know, if you look at 2023 demand estimates today versus 6 months ago, the demand estimates are 400,000 to 500,000 barrels per day higher. That's like 0.75% GDP increase if you think about it in those terms. So that's real strength. But there is real weakness in the manufacturing sector, and there's real weakness in the petrochemicals, and that's undeniable. So it really is a very much a split picture, and I think the thing that would really be a catalyst for higher prices in oil is if we do see the manufacturing demand, the petrochemical demand turn higher.